I had kind of a foundational knowledge. Like I knew how to underwrite a multifamily deal. I knew what made a good deal, and I knew how to, talk about that intellectually, but there was so much more to learn
Yeah.
working with him. And so I became a sponge and absorbed everything. I was trying to be on every call I could be on. So the learning curve was not as steep as I've seen it for other people who just maybe they quit a job or they leave a job and they've got no background or they haven't done the put a couple years into self-educating themselves.
Okay.
I did a lot of that from about 2019 to 2021 because I just got obsessed with real estate. I wanted to learn as much as I could. So I spent a good amount of time learning and connecting and networking and going to meetups. So I did a lot of learning before getting to Ironton Capital. So the learning curve was not as steep as it might be for a lot of people.
You're listening to The Accredited Life, hosted by Peter Neal. Make sure to subscribe and enjoy the show.
Nick, welcome to the show. How you feeling today?
Man, I'm good, Peter. How are you doing?
Awesome. Hey, I'm doing very good. It's a beautiful day. Keeping busy. So enough about me though. Let's talk about you.
Where do you live again?
I live in the suburbs of Philadelphia.
Oh, okay, cool.
Yeah,
I'm from
born and
Pittsburgh.
raised.
I'm in Pittsburgh, or I'm from Pittsburgh. I live in Denver, but
It's like opposite sides of the universe. I've never been out that way. I feel I've been to like close like the center of the state. I guess I've been to like Penn State and all. But I usually don't go much further than like Lancaster.
It's funny because somebody said this to me. They said Pennsylvania is two cities, Pittsburgh and Philadelphia, two cities that hate each other, with Amish country in between.
Yeah.
I'm like, that's so right, because I actually had never been to Philadelphia, living in Pittsburgh like my entire life.
Yeah, exactly. Yeah, I remember like in high school, there was like a lot of kids that went to Pitt. And I always thought that was bizarre. You know what I mean? Like, why the hell would you go to Pitt? And it's a good school. But it's just like if you're gonna go there and then just come back home, like why would you go there? You know what I mean? Why would you do that? But I don't know. I guess they wanted to change the pace and like going to the other side of the states, like going to the other end of the country. You know what I mean? It's just so different. It's far. It's not like an easy. It's like you're not gonna do that drive in a day or something, right?
Yeah, exactly. You still don't know people there. Maybe you do know people. I mean, is there really much difference between the two cities at the end of the day? It's
Probably
just,
not. Yeah, probably not. But that's funny. And yeah, I've heard the same thing. Like the middle of the state, it's kind of rural. You know, it's just not. You know, the density is in. You know, like some like the suburbs of Philadelphia. You know what I mean? Like the amount of they have more people in this little suburb than the whole entire middle of the state.
yeah. Yeah, I was back in Pittsburgh recently and I was there for Christmas and I'm in Denver and Denver's such a really a new, more modern city. And I guess the last time, being back in Pittsburgh last time, I was like, man, everything here is so old.
Mm.
Really feel it and you see it. But it was
Yeah.
it was a great place to grow up. Like all my family is still, within like a 15-20 minute drive of each other back home. So it's just a great place to grow up if you've got family there. And I think that's pretty common with a lot of people who are from Pittsburgh. Their family,
Hmm.
it's all there. And they don't often leave Pittsburgh. So it was a good place to grow up. So out of it. Yeah.
Yeah, Philly's got that in common. Exactly. The farthest people go typically is like New Jersey. Over the
Yeah,
bridge.
exactly.
I mean, I don't know. There's a thing about people in Philadelphia, South Philly especially, like moving to New Jersey. But yeah, people tend to stick around. So it's a generational place, and
That is.
so. But well, let's start with an introduction, Nick. Who are you? What do you do now?
Yeah.
What have you done? What's your story?
Yeah. So originally from Pittsburgh, had the good opportunity to get into the world of pharmaceutical sales through one of my buddies I played soccer with in high school. It's funny. So I graduated college, joined Mylan Pharmaceuticals. They had a headquarters in Pittsburgh. I worked at their Morgantown, West Virginia office. And I did that for about 8 months. And I said, I want to make more money and I need to get out of Pennsylvania. I went and I interviewed for a Lubbock, Texas outside sales position.
Huh.
So I was willing to go from Pittsburgh to West Texas,
Yeah.
which, we're talking about, Philadelphia versus Pittsburgh. Imagine going Pittsburgh
Yeah.
to Texas. And I didn't get it, but I met my business partner at that time because he was hiring for that position. He moved from Lubbock to he became the district manager and moved out to Denver. And he said, look, you're adventurous. You love to travel. You want to be outside. He's like, I grew up in Lubbock my entire life. You don't want to be here, but I've got the Colorado Springs position opened up. Would you
Mm.
be interested in moving on to the final interview for that territory? So that's what I did. So I went out, interviewed. I asked for the job at the interview. He gave me the job.
Nice.
And about a month later, I nestled into Denver. And I did pharmaceutical sales for since 20 from 2016 to about 2022. But in 2019, I bought my first house.
Okay.
So I got to
Nice.
chase the real estate. Um, I bought a 3-bedroom house. I house hacked it. So I lived in one bedroom. I rented out the other and bought a house for about 308,000 in 2019 in Denver. Immediately brought 2 tenants in. The 2 tenants covered my mortgage payment and paid me an extra $200. And from that point
Nice.
on, like I got the bug. I fell in love with real estate. I really was like, this is amazing. I basically saved up for my entire down payment in 1 year because I was working in pharma.
Okay.
So I made my money back in 1 year, and then Denver went just through an unbelievable time of appreciation
Mm.
from 2020 to 2022. I mean, Denver was seeing 15-20% appreciation in an already very expensive market, mind you. So people were getting 100K in appreciation in equity and selling their property just like that. It was unbelievable. But I got the bug. So I bought another house in 2021. I started house hacking it. I ended that strategy when my girlfriend, soon to be fiance, if she says yes, uh, moves in with me. So we didn't do the house hacking anymore, but I started really self-educating myself on syndicating, buying multifamily properties, partnering up with limited partners to take down bigger projects. And I really saw that just in talking to other people in the industry. I saw that as like this could be a real opportunity to maybe move away from pharma
Mm.
and pivot into this full time. So I looked at that, I saw it as an opportunity. And that was about it, and then in 2022, I finally got laid off. So after going through about 3 different layoffs at different companies and surviving them all, my luck ran out. So I got laid off in August of 2022 from that job. And I happen to just know a general partner at a company here locally, Ironton Capital in Denver. They're a private equity firm. They're fund of a fund. We're an equity group that invests in other projects as limited partners, but we take larger equity positions
Mm.
than your typical accredited investor or retail accredited investor. And they were at about 4 or 5 people on the company at that time. They were a startup. They brought me on and offered to bring me on to grow the investor relations team and help raise capital. And so it's pretty amazing when I look back at that because when I joined, we were at about 25 million in capital raised. In just about 6 months, they accomplished that. Today we're at about 85 million. So about 2.5 years later,
Wow.
we significantly expanded, launched 10 more funds,
Wow.
and we've raised about, $70 million, 60 to $70 million in a 2.5 year time period. And alongside that, I have a company with my 2 partners, husband and wife, Trinity Peak Partners, and we do value add multifamily, primarily concentrated in Northwest Arkansas. So
Mm.
since I got laid off under Trinity Peak Partners, we acquired 62 units. Of those 62 units, 53 of those being apartment projects in Northwest Arkansas, value add. And then I run the investor relations team at Ironton Capital. So it's been quite a journey. I didn't think when I got laid off this is where I'd be, but man, I'm grateful for it. It's fun. At the end of the day,
Sure.
yeah,
Yeah, that's all that matters is you're having fun and you're making money doing it
yep.
and you sounds like you're passionate about it. I always like to ask people that transition from one kind of field to another into real estate. Was there anything that you brought with you? Was it from a skill set perspective, all that stuff? Because I always think a lot of people might have it in their mind where it's like, oh, it's so daunting. I don't know how. I don't know this. I don't know that. And there's so many hats to wear in real estate. You're never going to know all these things. I mean, 10 years in, I still learn every day, and that's a part of the business that I absolutely love. But I always think it's more approachable to hear these stories. To find there probably are things you learned and that you've been doing that's going to translate over. Did you experience that?
Absolutely. When I mean, being in the world of pharma is pretty cutthroat and you have to perform. And, if a company goes through layoffs and you're one of the underperformers, you got to go looking for another job pretty much.
Hmm.
But learning how to sell, I mean, in the world of sales, you can if you're good at what you do, you can pivot from industry to industry. There's so many commonalities, not only just being a good sales rep, but also being like a good relationship builder
Mm,
and somebody that is always focused on delivering a premier customer experience.
mm,
And you'd be surprised. Being a good salesperson really just takes always being there when somebody needs you, being a good communicator, taking care of that client, and you can take that with you into any other industry. And so that's what I really think I brought with me. I'm obsessed with delivering a great experience to a customer, always being available, answering their questions and getting back to them quickly. And I have taken that same skill set with me into my job now. And I think I've amplified it even more because being on investor relations, you have to be good at communication. You have to be good at servicing the investor and servicing the client and being available and answering their questions, getting back to them if you don't know the answer. Like just a lot of the foundational elements that are so vital to just any sales role. That's what I brought with me. I think that's what I really excel at, and that's what I've done well at Ironton Capital, serving that role.
nice.
Yeah.
I love it. You're speaking my language. When I started in this business, it was on the investor relations side. And everything you said about, just providing the best customer experience, being there, answering the phone, getting questions all answered, all that kind of stuff. It's such an important part of the business.
Yeah.
And it's not for everybody. I have partners and I've met plenty of people over the years where they're really analytical, they're spreadsheet driven, they're all that kind of opposite end of the universe kind of stuff. And they don't respect or they don't value, I would say, the customer side of the business. I mean, and who's the customer? It's the investor. It's also your residents and things like that. And your tenants and residential, commercial. I think that's such an important aspect. And let's talk about that a little bit. Let's dive in. So you help me to understand and paint a picture of when you came on to the firm. What did it look like? Was there systems and process in play? What was the learning curve like? All that kind of stuff.
Yeah, the learning curve, I'll touch on that. I learned a lot. I mean, the guy that I work with directly with our CEO and founder, Lon Welsh, I learned a ton from him. He's been in the industry he started one of the largest Colorado real estate brokerages grew that
Mm.
to 700, 800 agents,
Wow.
and then sold that to a private equity company. In parallel with that, he started a title company and sold that to Compass, and he did both of these in 2021 at the peak of the market. You
Wow.
know, and on top of that, he owned 90 single family rental Airbnb properties and a couple commercial properties. And so you can imagine the wealth of knowledge that's come from this guy. And so I had kind of a foundational knowledge. Like I knew how to underwrite a multifamily deal. I knew what made a good deal. And I knew how to, talk about that intellectually, but there was so much more to learn
Mm.
working with him. And so I became a sponge and absorbed everything. I was try to be on every call I could be on. So the learning curve was not as steep as I've seen it for other people who just maybe they quit a job or they leave a job and they've got no background or they haven't done put a couple years into self-educating themselves.
Okay.
I did a lot of that from about 2019 to 2021 because I just got obsessed with real estate. I wanted to learn as much as I could. So I spent a good amount of time learning and connecting and networking and going to meetups. So I did a lot of learning before getting to Ironton Capital. So the learning curve was not as steep as it might be for a lot of people.
Mm. I
Um,
think that's a great piece there. You know what I mean? That you were self-educating and it wasn't like you were just at the 9 to 5, right? You know what I mean? And what you could pick up there, but you're doing nights and weekends and reading books and courses, I'm guessing, and all that kind of stuff. Speak to me a little bit about that in more detail for somebody who's maybe trying to get into this business or learn more about it or go from one aspect of it to another. What were some of the things that really helped you, that really made things click in for you?
yeah, great question. Obviously, reading books, that's only going to take you so far. You
Mhm.
can learn and learn and learn. I also like to read a lot of biography, so I like to learn. or from people and their experiences and their life stories who are, 20, 30 years into this and have achieved great success. So I also like to do that. Learn more from anecdotes as opposed to just, factual, boring information. And then networking with as many people as possible. I mean, that's really the name of the game. The more people you connect with in the industry, that are far ahead of you, the more you're going to learn. Maybe that's somebody that's 30 years ahead of you. Connect with somebody that's 5 years ahead of you and see where they're at, so you can kind of get that wide range of perspective there. So I think that's really what it is: connect, network, study up, and don't be afraid to, I took the first position with Ironton Capital. Like, it was a low paying compensation position, because it was a startup. Don't be afraid to, get in the mix, and learn from somebody that can be a really good mentor for you. And don't be afraid to do that for no money. I
Yeah.
mean, it's a lot easier said than done. I had a financial runway, so I was able to absorb the loss of income for a year, and ultimately it's paid off. But without even knowing like the comp model, I accepted the position right away because I knew it was a great opportunity to learn from people with so much more experience than me,
Yeah.
and I thought it could take my life further. So that's another thing. Don't be afraid to do some free work. Don't be, people in the industry, they want to pass on their knowledge. They want to help out the younger people, right? As they come into the industry and build up their track record. So don't be afraid to reach out to people, do it randomly, see if you can shadow them, see if they can be a mentor, and don't be afraid to do some free work to
Yeah.
get that education and experience.
Well, you know what? I talked about this on the show. I think that's going out on tomorrow. It's reframing. It's not really free. You know what I mean? You're getting a valuable education. You know what I mean? So you might not be getting paid monetarily, but you're getting paid in that education, which is going to lead to, ideally, if done right, you know what I mean, and implement it and execute it, it's going to lead to the monetary side down the road. I love what you're saying there. I mean, it's like looking into a mirror. Right? We have so much in common with how we started in our pathways and that kind of thing. You're really speaking my language. Let's talk about like the investor relations side. How does it look? Do you do a lot of marketing? Is it mostly sales? How do you get the phone to ring? And then once it does ring, how do you nurture and get somebody to come in and trust you enough to invest money, all that kind of stuff?
Yeah, so our investor relations team, we're primarily obviously raising capital and then producing quarterly updates for our investors. We don't really do much on the marketing side, but we do have a marketing department.
Okay.
They've got their marketing process in place, but what we've done that's been very successful is we are often doing educational webinars for a lot of investors. So every month we actually do an update on the national real estate trends and local Denver real estate trends, since that's most of our investor base. So every month we do that. It's me, our CEO, and then another gentleman in the mortgage industry. So we usually have about 150 people that attend that every single month.
Wow.
So that's huge. It's not branded. It's just, hey, here's what's going on, and we want to be the ones to tell you. And on top of that, we also discuss a lot of real creative strategies our investors can implement with their real estate portfolio. And I think that's been a massive driver, in our ability to raise capital and bring people in through the top of funnel. Is we do a lot of education that is industry focused and that is something that's very relevant that our investors can implement today. And it's not always, Ironton Capital branded type of marketing, right? It's just trying to be of value, discuss different creative strategies our investors can use with their portfolio and their retirement accounts. And we have done that consistently every quarter since 22, right? It's certainly helped that our CEO has built the largest real estate brokerage in Colorado.
Yeah.
That's
A lot of connections.
a lot of connections there.
That's
Those are a
amazing.
lot of the people that have attended our webinars, but I think that's been a massive driver in our ability to raise the amount of capital that we've raised.
Yeah, that's awesome. So let's talk about like the equity side. On your end, you have the other company you said where you're looking primarily in Arkansas. What led to that decision, and what's kind of the goals for that business?
Yeah, we kind of we stumbled upon Northwest Arkansas really accidentally. We were originally looking at a duplex deal in Tulsa, Oklahoma, and we just couldn't come to an agreement with the seller. So the broker actually said, "Hey, I know this deal in Fayetteville, Arkansas. I don't know if you guys are looking there, but it's a pretty good basis. You might want to consider. The numbers look good." So we took a look at it and we were like, "This is a pretty sweet deal. I know nothing about Northwest Arkansas, but like the going in basis here is very attractive." And this was September 2023. And we went out to the market, and just the more we did, the more due diligence we did in the market, and the more investors we talked to in the market and why do they invest there, the more it just became so obvious that we need to hone in
Mm.
on the Northwest Arkansas market. And so we ended up taking down that deal, 25 units, 1.95 million. Being in Denver, you can't even get like an eightplex for 1.95 million.
Sure.
And the rents were about 400 or 500 under market. And so it was
Mm.
just a sweet deal. And we didn't have all the pieces in place. So we put an offer in. We were like, I've never raised a deal. I've never raised money for my own deal without
Mm.
like having someone else's track record to back up off of.
Sure.
And we didn't know who we were going to use for property management. We didn't know who we were going to use for a construction team for the renovations. We didn't know any of those things. So we just took a risk and took the leap. And the more we went in there, we were like, fantastic market. Let's keep going here. So we bought another 28 unit 2 days before Christmas in 2024. We're looking for more, but it's a tough market. The word's getting out about Northwest Arkansas. It's a hot market. They see even more appreciation there than we see in Denver here, which is crazy just from a historical standpoint. And it's a hot market, and they're growing at a much more rapid pace than most markets in the United States. So, we want to keep focusing there. I think there's a lot of good long-term plays there. It's just harder to find some deals. So,
Mm.
I think we're looking at other markets too because the supply is pretty constrained there. We're looking at Kansas City. We were looking a little bit in Springfield, Missouri, since that's only 2 hours north. But yeah, we love to do deals all day in NWA.
Nice, nice. Yeah, it's I've been hearing a lot about Arkansas on the show. A lot of people have been bringing it up, and it's interesting. A lot of interesting things going on there that's driving the growth, and just some really promising things happening. What's the business model there? Is it value add? You guys hire third party management, and then you want to continue to hold, or are you looking to execute a business plan and then sell in a few years, or what does that look like?
Yeah, it's the latter. I'll tell you what, if I were doing this really with my own money, I'd love to just be a buy and hold
Sure.
investor, Northwest Arkansas. But in the world of private equity, it's you're driven on the IRR metric, and so
Yeah.
we also want to make money for investors too, so they can redeploy and velocitize their capital. But yeah, it's a value add play. Our 25 unit, for example, we bought that in 2023 of December. Everybody was month to month. So we did a 60-day notice and non-renewal, vacated everybody, and we finished the renovations from about February to June, started leasing up in July, and now we're approaching 90% occupancy about 15 months, 16 months later.
Nice.
Um, I would love to do a deal like that all day, probably
Mm.
less aggressive as far as like vacating everybody, but the 28 unit we have is in downtown Springdale. Uh, Less aggressive of a business plan, but similar scope. We're renovating every unit, repositioning, rebranding, and lifting the property up to more of a A-, B+ class property in downtown Springdale.
Nice.
I think that's a lot of people say development is the play there. It's hard to find a lot of value add there.
Mhm.
But I would love to do just deals like that all day long. We know how to execute them quickly. We know who our construction team is. We know who our property management team is.
Mm.
Everything's in place there, and we've got a good banking relationship too. So if I could do deals like that all day, I would. And I think that's what we'll continue to find. We just have to be a bit more patient.
Mhm.
Yeah.
Now, did you raise money outside capital for that? It sounds like you did. What did that? I'm assuming you took some of the things that you're doing now, on one side of the business into that, right?
Yeah, absolutely. We did raise money. We had to raise 900,000 for
Yep.
the 25 unit. The 28 unit we raised about 1.2 million for. So it's interesting. One of a real creative strategy that Ironton Capital uses that I stole for our deal was they have two classes of shares in all of our growth funds. You've got one class that gets a higher pref but gets no depreciation,
Hmm.
And you get the other class that gets a lower pref and gets all the depreciation.
Hmm.
And so I saw how valuable that was for a lot of our investors who invested in Ironton because they were selling rental properties in Denver and they were investing with us and utilizing that depreciation
Mm.
to offset the capital gains of the properties they sold that year.
Hmm.
So I took that same concept and I put it into our 25 unit. I did the same in our 28 unit and found that, okay, if we had X amount of money in the depreciation share class, we could get up to 90% write off in year one.
Wow.
Investors.
Nice.
So we had one guy that invested about 250,000. That was what was that? A little over a third of the total equity, about a fourth of the total equity.
Mm.
And we gave him a K1 with $215,000 of depreciation write off.
Wow.
He got to use against his sold properties that year. In our 28 unit, we delivered 114%. So I think that that was a strategy that really helped capture some equity. And just knowing a couple people that were in a position that they had a huge capital gain that they needed to write off that year,
Mm.
we could help them accomplish that goal by investing with us in our depreciation share class, but also deliver strong returns at the end of the day too.
Yeah.
I think that was a differentiator, and that's a strategy, as I've talked about it more, that not a lot of people know about. So I think that's a huge strategy that can be very effective.
Yeah.
Uh, a lot of
Yeah.
people look the potential of that depreciation. I
Sure.
think.
Well, that's powerful.
Yeah.
Now for the people in the other classes that tend to be like IRA accounts or something where, they're not really utilizing the depreciation or.
Exactly. IRA accounts. Yeah, they're already in a tax advantage account, so depreciation won't help them. Maybe just some other, high income W-2 earners who just can't, they don't have real estate or they're not selling
Oh,
something.
it is. So they're not utilizing the depreciation.
Yeah,
Okay.
exactly. Exactly.
Interesting. Yeah.
Yeah.
Yeah. And both sides are getting a pref for with an equity split or just an equity split or what does that look like?
Yeah, it's a pref, and then the waterfall continues from there. Typically about a 70-30 split up to an LP net IRR of 18% is how we structure it. So not gross IRR.
Gotcha.
Yeah.
Gotcha.
Yeah.
Interesting. Well, so where do you see the future hold? But you got kind of two worlds you're living in right now. Do you continue to do that, or what do you want to do?
I definitely want to be in both. I fortunately Ironton Capital, they know the deals we're doing. I think it makes me even better for the company, it makes me more valuable by
Definitely, yeah.
operator experience and knowing what good deals look like. And everybody at Ironton Capital's, they're doing other things too. They're all investors. They've got their portfolios and stuff like that. So I would love to keep doing both. I'm very optimistic about the long-term growth of Ironton. And now I'm a director role. I started off as just one investor relations guy. Now I'm a director. I'd like to continue to grow and mold into more of a leader at that company and take it to new heights. And so I want to continue to do that. And, I love everybody that I work with. It's a great company. We're a good group. And with Trinity Peak Partners, I would like to, maybe buy, one or two deals a year. I think if we can stack those over a 5 to 7 year period,
Yeah.
we could see some considerable wealth growth from that and make a lot of money for investors. So, I'd say I want to buy two deals a year between about 40 and 100 units under my portfolio with my partners, and then continue to scale and grow as a leader at Ironton. That's the
Yeah.
long-term mindset I've got.
That's awesome. I mean, that sounds like with Ironton, the relationship you have where you could do these other things and all. I mean, that's great. What kind of now you mentioned with Ironton that they kind of allocate capital as through their fund into LP positions, that kind of thing.
Yep.
So what are they like? I mean, what are you investing in through that business, and how has that evolved with everything going on right now with rates and things like that?
Yeah, great question. I'll start with the income fund. So we have a short-term income fund that provides a nice high yield cash reserve option for investors who want liquidity. So that fund's about, we generate about 9% a year on that fund. It's tax efficient, so it's taxed at 20%, and it's highly liquid. So if somebody comes to us and says, I want my money out, we can get it out within 7 to 14 days, just depending on the size. But it's a great option for investors who want to park cash short term. not make, 3%
Hmm.
on the money market or 0% at Chase.
Yeah.
They can put it here and make 9%. So that's
What does
great.
that fund invest in?
It's a hard money loan fund.
Oh,
So
did you say that or I if I missed
no,
that part?
I don't think I did. Yeah,
Oh, okay.
no,
I
yeah.
wasn't sure if you did. Okay, that makes a lot of sense. Okay. Okay.
Yeah, so we
Nice.
partnered up with a company here that they've got about a $300 million loan portfolio. They lend in all around Denver and Salt Lake City. So we partnered up with them. They've got a good system in place there.
Nice.
That's a good short-term cash option for investors. We have a midterm fund that returns about 12 to 13% a year. That's actually invested in a medical accounts receivables portfolio.
Interesting. I saw that on the website. Talk to me about that. What is that? What's the benefit? How do you operate that? I'm very interested.
Yeah, so all these signs, you see, somewhat so in Joe Smith Law, your personal injury attorney, stuff like that.
Look
Uh,
at
a lot of those, I see them all around Denver. It's a city guy or
that.
you know.
Yeah, commercials,
Yeah,
billboards. My
yeah.
God, I often wonder how do they all make money? Is there that many lawsuits going on? You know, that many
Oh my
people getting
gosh, that's their
injured at
job,
work?
right? Their job's to find these things. So they do a good job at it. But
Yes, they do.
you know, two people get in an accident, they need to be treated, by a physician. Uh, Attorneys, they take over the case, they work to settle the case, they represent their clients. But they've got like a backdoor handshake where they're referring their clients to certain medical providers, right?
Hmm.
And basically, what happens is it's when the auto insurer settles the claim, they pay the claim gets paid out to the attorney, who then owes the money to the physician for treating the patients, treating the people injured in the accident.
Okay.
What happens is it can take it
Yeah.
can take a long time for these to settle. It can take
Yeah.
6 months to maybe even 4 years for these
Yeah.
claims to settle. So what happens? Like, the physician office, the clinic, or the hospital, they end up building up this massive stack of accounts receivables that they're owed when these claims settle. So not only that, but they actually have to deal with all the paperwork, right? So they're paying staff to deal with this annoying paperwork between them and the auto insurer for when these claims settle. So what happens is like they get in a cash flow crunch. So they're like, crap, I've got $200,000 of aged receivables. I haven't been paid out on anything yet, but I need to get rid of this paper. I need to keep the lights on. I need to pay my staff, what have you. So they can sell the paper to us. We'll buy it at about a 70% discount, and then we'll take over the paperwork burden and we'll manage all the communication with the auto insurer, and we'll get the payout because we're buying the paper now. And then we get the payout when the claims settle. So it's this massive fund of just doing that over and over again across multiple states, dozens of physician clinics, dozens of hospitals. It's about 25,000, about a total of 25,000 invoices that the capital is spread across. And so basically the returns that we're getting is the payout from the claims, or we'll advance a line of credit against the outstanding receivables and collateralize it across the whole portfolio and get paid interest. So it's really either one of those two options. But we offer our investors, we get paid a certain amount, and then our LPs get to make, between 12 and 13%, and that's fixed. So that's what's great about the fund is we pay out quarterly. It's fixed at about 12 to 13%. It's not correlated to the stock market. It's not correlated to the real estate market.
Huh.
Interest rate volatility, everything going on right now in the economy has no effect on the performance of this fund, which is fantastic. So we've had a lot of adoption in that fund with investors that are looking at a lot of the uncertainty in the economy, and they want to be in something that's going to be reliable and deliver consistent cash flow.
Sure.
So that's our midterm fund. It's not as liquid. You lock up your money for a year, but then you can request full redemption or partial redemption. And then we have our growth funds, which is our national diversified funds. Our current NDF 10, we have two of these a year. Our NDF 10, we're allocating capital across 13 individual investments. We'll be in multifamily ground up construction or value add, self-storage, manufactured housing, some opportunistic debt lending opportunities. So we diversify across geography, the sponsor we work with, asset class, and strategy.
Yeah.
And really, that's our MO is, we want to provide a diversified option to mitigate as much of that risk as possible to our investors. And that's our growth fund. So, like I said, our current one has about, what I say, 13 investments. We'll have probably about 16 or 17 investments when we close it out. And we'll deploy our investors' capital across all of those investments. It'll
Nice.
be about a 4 to 6 year fund. Yeah.
Oh, okay. Okay. Very nice. I'm assuming the due diligence process for the operators that you're partnering with and all is pretty intense.
It's extensive. Yeah. We want to see, what did you do before COVID? Because everybody looked at the
Mm.
rock star in
Sure.
2021. So we want to see, what was your track record leading up to COVID? And we really like to take a look at it from that standpoint. If you did really well in that time, we're pretty confident you'll do well now. So we try to strip out those outlier, performing years of 2020 and 2021. But yeah, it's an extensive due diligence process, especially with new sponsors. But a lot of, we've been doing this for 2.5 years now and just been building relationships with all kinds of different groups.
Hmm.
Now, typically, these guys that have, hundreds of million in AUM or even billions in AUM, like they go out to their top 15, 20 investors. And if they fill that offering, they don't need to go out to anybody else. They'll close
Sure.
it up and they'll take down the deal, no problem.
Yeah.
So we've networked enough and performed enough where we're in that top 15, 20 investors
Yeah.
who get first look at that deal before anybody else. And so a lot of the investments we're making are repeat investments on new projects with sponsors that we've allocated capital towards. So,
Yeah.
but we're still looking for new sponsors, still looking for new developers and operators to partner with as well.
Yeah. Is there a typical check size that you guys want to be into it for, or does it just vary, deal to deal, sponsor, sponsor, that kind of thing?
Yeah, it really does vary. We partnered up with a workforce housing developer. Their latest fund, they raised $750 million for, and we've invested about 15 million with them. So as much as we've invested with them, that's a small percentage of the overall pie.
Mhm.
And then we've done deals all the way down in, like, in Denver. We're building a luxury home in an affluent neighborhood where we are the only equity position in that deal.
Hmm.
So, we'll cut a check anywhere if we're starting a relationship with an investor, anywhere from a minimum 250 to 500, depending on the allocation we can get, all the way up to, 3 million in one fund. So, really just depends on where we're at, what a relationship is, what their track record is. So it's a broad spectrum as far as how much we'll allocate.
Yeah. Now I would think balancing the deals with the fundraise, being that it's a fund and you're not like, advertising a specific deal necessarily. Any kind of struggle that, how do you guys balance that side where it's like, all right, we this is a good deal, we want to, but we need to raise X amount in the fund in order to participate in it, that kind of thing. How's that work?
That's such a good question. That's definitely the biggest challenge that we have. Because when we launch a fund, we may have 4 or 5 seed projects that we've committed to that total 1.5 million.
Mhm.
We've got no money in the bank. So
Yeah.
we're like, okay, we need to raise that money. So we put incentives in place to get investors to fund their capital early. We'll toss them an extra percentage point or two on the pref to get them to invest a little bit early.
Okay.
Well, but I'll give you an example. Like right now, a very real situation. We've raised about 2.5 million, and we've got to fund another 1.2 million. So by the end of April, so
Yeah.
it's like we're in this position where we found really good projects. We've put in our commitment, and now we need to raise the money for it. So I
Yeah.
wish the money was there, but it's not. Fortunately, we are in positions where we can lend the capital into the fund and then just pay off that loan as the
Mhm.
capital gets raised if we really want to commit to that project.
Yeah.
That's always a struggle. It's just that balance between investment committee and investor relations raising the money,
Mhm.
making sure the money is there for the projects we're committing to.
Yeah.
It's a challenge every time. We're getting better at it, but it still is a challenge being 3 years into it.
Yeah, no, it's I mean, I've been doing it for 10 years and it's always, I mean, I always think it's funny when people say, they're going to raise a fund because it'll be easier to close on deals or something like that and all. And it's just like the money's not just going to be sitting in the fund, all the time. And funds come with their own set of challenges and things like that. And there's different objections and investors that look at funds differently than an individual syndication or something like that. So I always think it's funny when people say that. It's like that's not gonna, if that's reality, then God bless you. You know what I mean? Good for you.
Yeah, they make it
Um,
look easy. You just start a fund. Oh,
yeah,
I never thought
exactly.
about it, you know?
Exactly.
I mean, the money's going to come pouring in, though. You know, people that are really good deal by deal syndicators, running a fund's a whole different operation.
Yeah, it is.
You know, so you still got some challenges to get accustomed to.
Yeah.
Yeah.
Well, Nick, this has been an amazing conversation. I love what you're doing. I love there's so many things we have in common there. So like, just great story. If somebody wants to learn more about, what you're doing, how can they get involved with you?
Yeah, I mean, you know, I've got my LinkedIn. I'm pretty active, so you can go to my LinkedIn and DM me, reach out to me, what have you. Like I said, I'm active on there. I post often, so I usually do a pretty good job responding to people. I'd say that's probably the best route to go. So if you want to chat, just head to my LinkedIn and let's connect.
Great. Awesome. Well, Nick, thank you so much. I've really enjoyed the conversation. I appreciate you coming on and talking to me.
Thanks, Peter. Thanks for having me.